Good evening, everyone. Thank you for attending tonight's Hookup with Real Estate Masterclass. We are super excited to have our special guest, Avishkar Sabharwal, and I will introduce him in just a minute. First, we have a few housekeeping items to talk about. Ken, would you please read the disclaimer?
Bear with me 1 second. I have to delete that. Okay. We appreciate you attending the Hookup with Real Estate Masterclass presented by co-hosts Kenneth and Donna Hook. We are not financial advisors. The content we provide is strictly for educational purposes and not intended as legal, financial, or investment advice. Remember, participation in this program is at your own discretion. Real estate markets are subject to change and can be dynamic. Hookup with Real Estate and its representatives are not liable for any outcomes resulting from the information provided. Seek professional advice before making any real estate or investment decisions. By attending, you consent to this event being recorded and understand that internet security is not absolute.
Thank you, Ken. All right. Our mission is to provide aspiring and early real estate investors with exceptional education, skills training, and opportunities to invest in real estate while simultaneously sharing strategies to avoid costly mistakes like those my husband and I made early on in our real estate journey. And you can read about our journey in the book, Real Women in Real Estate, Volume 1. You can get it on Amazon, or if you'd like a soft copy, I can send you a signed copy. Volume 3 is actually coming out in a couple of days, maybe 2 weeks, on 10/10. So these stories are filled with inspiration. I think you really like them. Okay, next up. Just quickly, Ken is a licensed New Jersey realtor, veteran, and sorry, let me go back. You know, if you're in the northern New Jersey area looking for a realtor, please contact him. Like at this website. Okay, we are powered by Legends Equity Group. This is one of our mentorship groups, and you can see here I am. They do additional training called the Rookie Roundtable on Monday at 7 p.m. So check that out. It's also at no cost. All right. So through Legends, there's also a powerful real estate investing training. It's a deep dive into real estate syndication. There's 60 plus bite-sized video learning modules. Run by a professional real estate investor, AI tutor. You get to be part of a free, like-minded community of individuals, and it's a super deal at $97 with the code ROOKIE. And you can get that at https://tinyurl.com/multifamily masterclass. It's a great training. I took it once and finished. My husband took it once. He's on his second go around. So it's highly valuable training. Now, just quickly, here we are in September. We have 3 more trainings left this year after tonight. The October is the normal schedule, but November and December are really going to be on the 3rd Wednesday, so as not to impact the holiday, conflict with the holidays. And there are 2 ways that you can stay connected to us. We have a YouTube channel at Hookup with Real Estate and a Facebook groups page, so you can stay connected here as well. So also Hookup with Real Estate groups /Hookup with Real Estate. Okay, Ken, can you please read the quote of the day?
I sure can. An investment in real estate is a surefire way to build wealth over time. Sam Zell.
And Denzel wrote a book called Am I Being Too Subtle, which was quite good. All right, now we get to the good stuff. I have the great pleasure of introducing our special guest, Dr. Avishkar Sabharwal. Avishkar is an immigrant physician from India who currently works as a hospitalist in the United States. Growing up in a family of physicians, he witnessed the hard work and sacrifice required to provide for a family. Inspired by his mother's entrepreneurial spirit, Avishkar developed a desire to find a better way to achieve financial freedom and generate passive income. After exploring various methods of generating income, including day trading and cryptocurrency, Avishkar found his true passion in real estate. He began investing in small multifamily properties and soon realized his heart was in owning and operating large apartment buildings. He's currently partnering with highly experienced individuals in the industry to aggressively acquire assets and expand his portfolio. Despite his focus on real estate, Avishkar believes in diversifying his sources of income to offset any potential downturns in the market. He plans to explore other asset classes in the future while continuing to build his real estate portfolio. Avishkar's ultimate goal is to create multiple sources of passive cash flow that will provide him and his investors with financial freedom and the ability to spend time with their families without the stress of money. And tonight, he will be talking about the RX of capital raising for real estate investors. So I'm going to stop sharing, and then we're going to welcome Avishkar.
Thank you so much, Donna. Thank you, everybody. It's really an honor to be here in front of you talking about, raising capital. Donna, how do you want to keep it? Do you want to keep it like a question answer format, or do you want me to kind of, start talking however you want me to serve the audience? I'm happy to do it that way.
Yeah, well, we'll start with one question. How did you get into real estate? And then we'll go from there, okay?
All right. So that's a great question. That's the $1 million question, right? How did I get into real estate? So, my parents used to own real estate back in India. I'm from India, guys, originally. And so they own real estate in India. The way real estate works in the subcontinent is very different than the way it works over here. And so it was kind of, in the blood, because they've owned a bunch of, smaller assets and they sold them, and we saw the appreciation coming in. And so when I came here, I was looking for ways to create passive income. And like you mentioned, I tried my hand at day trading because I was like, okay, I had actually seen this movie, The Wolf of Wall Street, and he was trading penny stocks. I was like, man, I'm going to get rich quick. I'm going to go day trade and I'm going to make a ton of money. And, I'll be rich and I'll retire. Right. And guess what? So I distinctly remember this story because this was super stressful for me. So I was in residency here, and then I was after a night shift that I was like, okay, let's just do it. How hard can it be? I just have to log into my account and then just start trading. So I logged into my account. I started trading in penny stocks, not knowing what I was doing. I was like, yeah, it's like whatever. When it goes up, I'm going to sell it. And I put in the money, and then every second I was checking on it. And, bear in mind, I'm like post call, like I finished a night shift at the hospital. And here I'm sitting super stressed because I put in money into this, and I'm seeing it just go away in a matter of minutes. Right. So I remember for 3 or 4 hours, it was like that. I would lie down and I would get back up, and I would go into the computer. I'm like, what is this doing? Is this going up or is this going down? What is happening right now? So 3 hours later, I'm like, I've lost $300 in 3 hours. And I decided this is not for me. I am not going to be trading. No way. So I was like, I need something that moves slower. I need something that I can understand. I need something that has numbers around it that makes more sense. That is how I got into real estate.
Okay, that's a great story. I know we've all tried our hand at different kind of investing, and yeah, it doesn't always work out the way you think. All right. So tell us about your first deal. So you got into real estate, but what does that actually mean for you? So did you get
Yeah. So
educated?
yeah, that's a good question. I mean, I did start actually with mentorship. So I did not know what I was doing because, again, I had no idea. All I knew was that you just put in a lot of money to buy an asset. I did not know about how leverage works, how debt works, how do you underwrite a deal. I had no clue, right? So I had to find the right mentors. I found my first mentors who were also physicians and had been in real estate for quite some time. I actually learned a lot from them. I learned a ton of things. I learned how to underwrite, how to actually evaluate a deal, how to look at the property. But what happened was, and after that, we decided to build our house. So I got busy with that. And then, real estate investing took a back seat for some time. So once we finished that, I dove into this thing, and I was keeping abreast with the information, learning more, learning new things, incorporating it into my own persona, into my system, because it takes a while to understand everything better, right? And so once I was done, I was ready to invest. It was not like, can I do this or I cannot do this? I wasn't having cold feet or anything. I was like, okay, let's do it. The numbers make sense. Let's just go and do it. So, but it was very hard because that was 20, I want to say 2020 or 20, no, it was, I think, 22 or 2021 is when I bought my first property. And it was like almost the peak of the market. And so it was 2022, I think. So it was the peak of the market. So nothing was making sense. The numbers would not pencil out. I was getting very frustrated. I'm sitting here crunching the numbers, looking at every deal that's presented to me, looking at everything on the MLS, and nothing is making sense. And I'm thinking to myself, is this even worth it? Should I even go ahead with this or not? Right? Like, I'm wasting so much of time on this. I'm taking time away from my family and putting into this. Like, what can I do over here? And so finally, we found something that was barely meeting our buy box. I was like, okay, let's go and do this. So I bought that. And I don't know if you guys have heard of the rule of three. Like, you buy one and the next two deals will flow through immediately. So that's kind of what happened. So immediately after that, I got two more deals. Long story short, they were, so one of them I was impatient on, I'll be very honest. And that's a lesson that I've learned, which I think is very important for new investors to understand, that it's easy to get frustrated when you're starting out, but patience is your friend. What I learned was I was over optimistic on the numbers. Now, this property still cash flows. I still hold it in my portfolio. But when I bought it, I was over optimistic with the numbers, and it was a headache. And believe it or not, it still is a headache for me to hold that. The only reason I hold it is because I know it's going to appreciate. It's still positive cash flow, more or less. We have been tweaking things around. So that's number two. Number three was another big headache that I bought. So, for people who kind of, if you're looking online and like, oh, real estate is great and get into real estate. No, I think you have to understand there's a lot of effort that you need to put into real estate, a lot of understanding that you need to have, and a lot of resilience that you need to have when you're getting into this business, because I've seen people quit. Sometimes it is just too hard. And, it's like you question yourself. Is it really worth it? Am I doing something that I could be, am I putting my time towards the right thing? But I think the important thing is to understand that you got to stick with it. You got to kind of persist and get past that. And that's when you kind of start seeing things moving for you.
Yeah, thank you. So tell us a little bit about those properties you bought, the first three. Were they single family? Were they multifamily? What were they?
Yeah, so I've never bought single family. So the first one was a duplex. The second one was a quadplex. The third one is also a quadplex. So, yeah, the first one was relatively okay in the sense that it required a lot of rehab. So we did that. That went smoothly. The second one went okay, but man, the challenge was that I could not rent out one of the units for like 8 months, right? 6 or 8 months, we just could not rent it out, right? I'm holding this property. One of the units is not rented out. The other units are under market rent. The top units are also struggling because either the tenants are not paying their rents or they're looking to get out of the property. And I have this huge fourplex now sitting there that's not making me money, and I'm paying mortgage on this. It was frustrating. So I had to, luckily I was able to hold on to the property, right? Some people might not be able to hold on to it. I had to go pick up extra shifts at the hospital, make sure I'm keeping it afloat. I did not want to lose it, right? So then this asset is sitting for this unit is rehab, beautiful, sitting for like 6 months on the market, no renters, right? Part of it was also probably my property management. They did not do a good job of getting a tenant in, so I would blame it on them. But I should have caught on this early. So this is what I did. Um, so I was like, okay, how can I know I'm losing money here. Is there a way that I can make money on this, right? So how do I make money on this? So instead of looking at it from a long-term rental perspective, I decided that I'm going to convert it into a short-term rental, right? The reason being, there's a short-term rental loophole. You can get the material participation, you get depreciation, and you can get bonus depreciation and actually offset your active income. Now, I will give a caveat. I'm not your CPA. I spoke to my CPA. We discussed the strategy, and that's how we went with it, right? So guess what? We did kind of like something like that. I converted into short-term rental. At that point in time, this is November. We're in November, and I'm deciding, okay, whether I should convert it into a short-term rental or not. And I had to do a lot of calculations. Okay, how many nights do I need? How many? Because it has to qualify as a short-term rental, not just by putting on an Airbnb will it qualify as a short-term rental. So I'm doing this math. Okay, I need these many people coming in for these many nights, and I had to restrict it like 1 night stays or 2 night stays in the unit, so that by the end of it, it would qualify for a short-term rental. So it was crunch moment for me for like 1.5 months. I was like biting my nails, trying to figure out, I hope this goes through. I hope it will qualify as a short-term rental so that I can get my tax break, right? I was renting my 2-bed, 1-bath unit out for $40 a night just so that I could get people in because I wanted the tax break. So I do not recommend people do that because this is sort of, I would say, sort of an advanced strategy is the tax break part of it. It was something that I was doing because something else wasn't working and I wanted to make some money off of it on the back end or save some money on the back end. Yeah. And we were able to pull it off actually, and we got a pretty good tax break from that. So even though the full year I did not make money from it, I made more money on the back end by doing this because I understood how things work in the short-term rental space, how I understood some of the tax stuff. I had a great CPA to do this. So that's how we were able to pull it off. And so whatever I would have made in the year from my long-term rental, I made more than that in my tax break from that. Nice. So that was that story. My third fourplex has been sort of a nightmare. We're kind of coming to the close of that bad chapter, and we're finally ready to do, and we're kind of deploying, employing some strategies in that as well, so that it's going to get us some, good returns on that property as well.
All right. No, pivoting is really important, right? Because sometimes the strategies don't work out and you have to figure out a way to make them work for yourself. So good job with that.
Yeah. And I think it's, it's about understanding what tools you have available to you. And I think that comes with education. Like I would not have known about this had I not educated myself on this, right? I would have had no idea. And also having the right team behind you. My CPA is a specialist in real estate. I actually had to fire my old CPA to hire this new CPA because he understood real estate taxes, right? If I would have kept on with my old CPA, he was going to really screw things up for me. And so, it also depends on who's on your team.
Yeah, that's another important point. So get with the right people. Maybe I'll text you later to get the name of your CPA. We could use a good one too. All right. So for those properties, you were using the MLS to find deals, or did you use some other source to find deals for those properties?
Yeah. So one was on the MLS. The other two were off market. Okay. And the third one, I bought it in like 5 minutes. Like I saw the deal, I ran the numbers, and 5 minutes later, I was under contract. It was like that.
Okay. So were you doing these fourplex yourself, or did you have partners also?
No, it's all me.
They were all you. Okay, so then how did you shift from, quads and duplexes into now thinking you want to go bigger into multifamily?
Yeah, so it's you can. The thing is, with my physician background, I could, it takes a lot of effort to do this, and for the same amount of effort, I could have been doing something bigger and something more meaningful, and so that's why I decided to go into the bigger space and the private equity space.
Okay, so you knew about bigger syndication from your education, I'm guessing.
Yes.
Okay, so then you're thinking like, all right, this is good, but it's a headache. I learned a lot. Now it's time to try my hands in commercial.
Yeah, and I think that comes down to mindset. I've been very thankful that I've had people who've kind of guided me, and I've been a part of a community that has a similar mindset as me, or that is a growth mindset, and we kind of push each other forward, right? It's like you cannot do it in a silo, you cannot do it in isolation. You need people around you to push you forward and to kind of pull you up when you're down. So I've been very fortunate to have that kind of a community around me, right? I would not have been able to do it. I've seen people quit, and if you're doing it in a silo, if you think you can do this alone, it's very hard. It's a very long and hard journey, and you need people who can, who will root for you and actually support you.
All right, no, that is true. Especially in commercial real estate, because there's so many different parts. There are people that have to find the deal. There are people that can put up the earnest money. There are people that can raise capital, which we'll get into shortly. There's people that have to manage the assets. You have the key principal. So your community of doctors, I guess, are filling most of those roles now, right?
Yeah, it's so my team. So for my multifamily team, it's actually I'm the only doctor there. So there are no other doctors
Okay.
in that team. It's people who've been in real estate or in different, from different walks of life. Actually, one of them is a CPA, and so they're basically from different walks of life, all doing real estate, and I'm the only doctor there.
Okay, so how did you find your team? That's always
Again,
important
and the
thing.
networks that I'm in, it's all community. It's all where
Okay.
you are. You talk to people. We've been together with my team for about almost 2 years now, and it's all about where finding the right people and then just sticking with them.
Okay. Learning together, growing together.
Absolutely.
All right. So now you're looking at multifamily properties, and explain, what happened. How did you get your first property? Who found the deal?
Yeah.
etc.
So this is what happened actually. We started finally, we had formed the team. We were looking at stuff. We started in actually end of 2022 is when we started looking at stuff. And then basically the interest rates just went through the roof, right? Nothing was making sense. Nothing was cash flowing. So what that did was that gave us a lot of time to internally set up our processes, or how we organize the deal flow, how we hold our meetings, whose role is what. So we had a very concrete, we developed a very concrete plan around that. So together we have not been able to acquire a property yet, but there is an active a meeting that happens. That one happens without me, one happens with me. And we can go into how the teams are structured and the meetings are structured, but that's where the acquisition team meets, and they decide based on the buy box that we've decided whether to look at a deal or not. They're actually primarily taking care of most of the heavy lift on this. My role is to oversee everything. My role is to kind of give my strategic inputs into the deals, and then kind of they run with it, and then basically we get capital in.
Okay. So if you have not gotten a multifamily, but you have raised capital for other people's deals?
Yes. Yes.
Okay.
Yes. So I have raised capital for a development project in Dallas. And thank you for reminding me that I was actually going to go to that. So what happened was that 2020, nothing was cash flowing, nothing was making sense. That's why I was like, okay, I need to get something to my investors, because I'm talking about this stuff. I need to have something that's going to be right for them. And again, I'm going to come back to the fact that this is having your community, because this deal did not come through me from the internet. somebody recommended this deal to me. So that's how I looked at it. And I was able to present it to the investor. So that was the first one that we raised for, is a development deal. It's still open. We're still raising for that. The second one is actually is not a real estate deal. It's completely different. And then I'm involved in some other alternative assets as well, like oil and gas. So I'm a partner in a fund, an oil and gas fund. I'm a partner in actually a development fund here in Virginia, where I'm located, as well. And so we're raising capital for that and deploying it into development deals.
Okay, cool. So you have these projects that need capital raising. So let's go right into capital raising. How are you finding people to raise capital from? Is it your networks? You know, how are you figuring out how much capital you need to raise? What is capital raising for our beginner?
Yeah, I think when I started, I was also challenged with this question of, okay, how do I go about this? And really, I think the first place where a lot of people start is their friends and family, because at the end of the day, what I've realized doing this for 2-3 years now is this: a great business plan can be screwed up by a poor team, and even a poor business plan or a poor project can be made better by a good team. So really, it's about finding the right team that to work with, number one, so that you can back the project, right? You need to make sure that the project that you're going to be raising capital into is the right project to get into, right? Now, that being said, things can go south even with a great project. We saw that happen with the interest rates going up. That was not in anybody's hands, not in anybody's controls. And people were going exactly according to the business plans, but the valuations of the projects went down just because the interest rates went up, right? So things can happen regardless, right? So making that very clear to your prospective investors, right? So it all boils down to trust. It really just boils down to whether they trust you with their money or not. Because at the end of the day, most of the individual investors will not be able to do the due diligence that you will be able to do. At the end of the day, they're putting their trust into you to be good stewards of their money, which everybody should be, right? And essentially, that's pretty much it. Like, find good quality deals, make sure you're comfortable with the deal, and it's okay to say no to deals if you are not comfortable with it, because there is no dearth of deals. But that being said, you have to make sure that when you have, when you're looking at investors or you're looking to get into capital raising, start talking about this stuff. Even when you don't have a deal, at least you have the theory in mind. Start talking about it to people, because guess what? People are busy in their lives. They don't know what you're doing. They have to see you multiple times. They have to understand that you're in this space, you're working in this space. They have to see you looking at, what you're doing. This is what happened to me. I texted somebody, and this guy I have not spoken to him for a long time. And his message reply to me is, yeah, I've seen you on Instagram. Let's connect. I've seen what you do. So I had to take the initiative of connecting with him. I had no idea that whether he'd seen me on Instagram or not, whether he'd seen me, do my presentations or not. And I'm connecting with him, and he's like, okay, let's talk. Right. So it really is about putting yourself out there and letting people know that you're doing this. The other important thing actually, is that you should not be raising capital when you have a deal that's ready. You should be raising capital even before you have a deal, because guess what? Urgency will never get you capital in, right? People will smell desperation and they will move away from it.
Yeah, that's a good point. Start early.
You should always be raising capital. There's never a moment when you stop raising. Say you've done a deal, or for example, even for our fund, we're raising a pretty large allocation for that. The moment we're done with that, we're immediately going to round two. Actually, I've already started talking to people for round two and told them that, as soon as round one's finished, we can probably take round two. So it's like, it never ends. It never stops. You immediately go into the next round.
Now, you have had your duplexes, so you had some experience in real estate, but there's some people here that are just kind of brand new to real estate. Anything extra you can share for them about capital raising?
I think so if somebody's completely brand new, right? So there are two ways to do this. Either you invest your own capital, which I did when I started out, right? All of that was my own capital that I used. I did not use other people's money for my first few deals. You can do that, or you can partner with people and put in the sweat equity, learn the trade, learn the business, go put in the effort, go make sure. You can even work as somebody who's managing the tenants. You learn so much. You can say, hey, look, I'll put in the sweat equity, I'll find the deal, I'll underwrite the deal. You be the passive investor or a passive partner, and we just partner and do the deal together. That's right there is capital raising.
That's great. So when you're talking on social media, what are some things that you found that worked well, to help you support your capital raising?
I think honesty and, being yourself is the most important thing when you're on social media. You should not try to fake something. If you don't know something, that's perfectly fine. Actually, people like to see the journey that you're learning things more than, you know everything, because you appear more real, more approachable. So I think just that I would say would be very helpful. And the other thing is consistency. Like, do not post once and then be gone for a month and then come back and post again. Consistency every day, every day, every day. It's a lot of effort. It takes a lot of time, but that's kind of what gets you some results. And it's going to take time. There'll be months before you can actually start seeing the results from it. But that's the name of the game.
Yeah. Now, when you're raising capital from somebody, do you do any kind of analysis to make sure you're not taking their, let's say, last dollar or,
So we're at a point where we're not raising from non-accredited investors, right? So we always raise from accredited investors. And so I'm really, at that point in time, I'm not doing any analysis on whether it's their last dollar or not. Really, they are accredited investors. So,
So maybe you want to explain that for people who are new.
Yes. So accredited investor, there are several criteria which make somebody an accredited investor. Basically, the SEC said that these private deals that are done, or even the public deals that are done, right? You should not stiff the small guy. Like they don't know that well. You go and pitch to them. You're a sleazy salesman, and you should not take away their money like that. And we will come and penalize you for that if you do that. So they have these exemptions like the 506B, 506C, Reg D, Regulation D, 506B, Regulation D, 506C. Then they're very strict about it. So we do we take the Regulation C. So there's a question: have you raised money from non-accredited? Yes, I do have somebody who's a non-accredited investor. They've been wanting to invest with me. I do not have any deals that support non-accredited investors. Right. So we always go for the 506C exemption, which is that you can only raise from accredited investors, because it gives us some leeway, because we can advertise the deals, right? We can publicly go and talk about it. I can come here and talk about the deal without the fear of SEC coming and slapping me on the wrist. So the accredited investor, basically what SEC said was that, say you're advertising the deal and somebody who's not an accredited investor, that means they don't either have in the eyes of SEC, have the acumen to understand the deal, or they don't have the financial bandwidth to invest in the deal, and they get swayed by your presentation and they invest with you. Like that's not cool in the eyes of the SEC. And so they have, so basically if you're advertising, it's pretty much, unless there are certain, there are certain other regulations as well, certain other exemptions where you can go into it. But let's not talk about that. Let's talk about the 506C, is where it's like you're advertising, you're only raising from accredited investors. Those are, in the eyes of the SEC, either have the financial wherewithal to manage it if the investment goes south, or they understand the business that you're in.
Yeah, no, that's a good point. So one easy way that I like to remember the difference between 506B versus C. B is for both, I think, accredited, non-accredited, and C is more like controlled. So people who have the higher net worth who can invest SEC regulations.
Yeah.
Okay, so All right. So what else can you say about capital raising? Like what else should somebody who's aspiring or early real estate investor, never done capital raising?
Yeah, I think what happens is that this was me, guys. This was me a few years ago, right? This was me. I had very little experience in real estate, never done capital raising. But guess what? I started talking about my journey, and it takes a while. Even now there are like phases that you go through, right? It's election time. It's more challenging to get capital right now than it is in other times. Like 2015, 2016, the market was flush with capital. Right now, it's, with the change in the economy and everything, it's a little tighter. People are a little skeptical. I've had this question asked to me from a potential investor that, hey, what happens if the economy goes down? There is speculation that the market is going to crash. So you will get those questions. And so there are cycles in the capital raising space as well. Like sometimes the market will be flush with capital. Sometimes it'll be harder to do it. But usually when it's harder to do it is actually a good time to invest because everybody's scared and you'll get good discounts on the deals. So what I would say is that partner with people who know what they're doing, who have experience in this space, so that when you're going to your investor, you can say, look, you don't have to rely on my experience. You don't have to rely on me at all. But I have this person I've partnered with who's done this a number of times, right? They've done it for a freaking decade. And you should, if you don't want to trust me, you should trust this guy. Right. Mm-hmm. And so that's what I would say is experience, partner with people who are experienced and who know the market. And so again, that also is going to be like, you have to talk to them multiple times to make sure that they're not kind of, just again, trying to take advantage of your situation or trying to take advantage of you, and make sure that they're going to be a right, steward of your investors' capital.
Yeah. So when you're talking to people, are you giving them like pitch decks, or are you giving them webinars, or what are you doing?
Yeah. So when we typically raise capital, we're talking to them and we're giving them, we do a webinar. So typically when you're raising capital as from the investor, you have to explain the project to them. Okay, this is what we're trying to do. This is how it's going to go. These are our projections. Of course, there are disclaimers that, okay, this may or may not happen. Of course, these are all investment opportunities. And then, this is the investment, this is the lock-in period, this is the end time and stuff like that. So yeah, you have to present all of that to the investors when you're raising capital. And then it's also constant follow-up. Like you cannot just present it to them and be like, okay, fine, let me know. You have to constantly follow up with them because, like I said, people are busy. They will forget. You're not the most important person in their lives. I mean, I'm sorry to say that, but like, I'm not the most important person in my investor's life, right? Yeah. I have to follow up with them. I have to make sure that I'm like, hey, by the way, I just wanted to check in and see, what's going on with that? Have you checked into that deal? Have you done this? It's constant follow-up. Every few days I follow up. Every few days I'm following up.
Get to know another. Oh, got to go to another call. All right. Thanks, Fraser, for joining. Yeah, constantly following up. So are you raising like money into your fund before you have some? I guess that's the way funds are working these days. You're putting
so
money
that's
in your fund. So we can take a little pivot to a fund.
So I think, so that's what happened actually was that initially I was looking at individual deals and I figured that the challenge with the deals is that you find the deal and then you're raising the money, and you find the deal and you're raising the money. And instead of that, I can have capital ready in a fund and then easily deploy it, right? The flip side is that if it's a first-time person doing this, people are not going to trust you with their money. How do you do this? You got to have a track record. That's why keep saying that if you don't have a track record, go find a team that does and work with the team. Be okay with working extra and taking a smaller split, because that's giving you the experience, number one, and that's giving you the credibility, and that's giving you your track record. So, that's something to understand, that you might be working harder for a smaller split. Sometimes depends on the team, but you'll get a lot more than just the return on your, sweat equity, in terms of dollars.
Right. You definitely will learn a lot for sure. So just talk a little bit about, what a fund is briefly, and,
Yeah.
how it's different than find the deal, fund the deal.
So a fund is essentially a pool of money, right? So it's a pool of money that you've raised beforehand, and then you're just telling the investors, look, we have this fund ready. We're going to find XYZ deals. We have this is our buy box. Our deals are only going to be in this buy box. And then as soon as we find a deal in that buy box that meets these metrics, we will invest capital into that, right? So we can do that because we have the experience, trust us, and invest with us. Now, there are certain more nuances in that and different ways you can do this. You can have the capital ready to deploy sitting in an escrow account, or you can say, look, I don't want your capital. I just want a commitment. But, we'll do a capital call. That means we will call your capital due when we find the deal ready to deploy, and you have to invest the money within 10 days. Otherwise, you'll get penalized. So, and that's very standard practice in funds. So, it can work various ways, right? It depends on what you want to do, how you want to do it, and how you want to raise. And so it's very flexible in those terms. But sometimes starting a fund can be a little more challenging in terms of having the track record and having the credibility. Like somebody who's brand new to real estate, I would not recommend them starting a fund at all. I would say first get educated in the fund space, get educated in the real estate space. Because funds work differently than real estate. And, there are certain regulations that you got to be wary of. There are certain things that you got to understand, certain compliance issues. And I would not actually recommend setting up a fund legal structure even before you've pitched it, because this was actually sound advice given to me by a securities attorney. It was like, do not waste money on actually getting the PPM and everything prepared for your fund before you've pitched it to investors, because you need to know if the market is going to accept it or not. Otherwise, you will end up spending $20,000, $30,000, $40,000 on this. And what if it's a bad market fit?
Yeah, that's a good point. Wow. That probably saved you a lot of money to go and figure out if it was a good investment.
Yeah.
Nice. So I know I've been asking a lot of questions. Ken, do you have any questions for Avishkar?
Let's see here. I have some. I just want to make sure and see if he's answered them. Oh yes. What platforms of social media do you use mainly to find your investors?
I think everybody has. Here's the thing. I think everybody has their favorites. My favorite is LinkedIn. But that being said, like I said, the guy messages me that I've been seeing you on Instagram, right? So the investors are everywhere. You don't know where they'll come in from. Find your favorite platform and then kind of, go market on that platform. And by market, I mean, just let people know that you're doing this stuff and educate them.
Okay, and so in regards to that, the method, or excuse me, the platform you use, what do you find is the best method to get the people to actually invest in you? I mean, how much material do you feel you have to put out before you actually have people invest in you?
Yeah, it's a lot of material because you have to build that trust. Remember, people are going to invest in you because they trust you. They've seen you enough number of times. Actually, Google did a study on this. I think it requires 7 touch points or 11 touch points across 7 different platforms across 4 different times or something like that. There's a study by Google. And so and this is not for investment, it's for people to buy products from you. Right. And so it applies to capital raising as well. Like people need a lot of touch points to get that, for you to have that credibility in their minds that, okay, yeah, this guy is legit, or this girl is legit. I can trust them with my money. And so it takes time, takes effort, but it's like I said, you cannot just go post once on any platform, right, in a month and then be like, okay, I'm done. It has to be every day. It really has to be every day.
Yeah.
Okay, and also you said you actually haven't purchased a multifamily deal yet, correct?
Not with my team, no.
Okay.
No, but he's
So,
in other deals. He's raised capital for a big
Yeah.
project
okay,
in
so
Dallas.
people, so when you get investors, you basically refer them to the other people who have done the deals.
No, they are investing into my security.
Okay.
And so I'm raising from that. And so we've had some individual investors come in. Right now, we are in talks with one of my institutional investors for a pretty large allocation for our fund. One of the funds, we're in talks with another international investor of mine for a large allocation into one of our other funds. And these are not like, $50,000, $100,000 checks. These are very sizable allocations that we're talking about. And so we're like, for one of them, we're almost like 80% of the way there. We're finalizing a few things. Hopefully things will go through and we would have funded that, the first allocation of that. So yeah, it's a constant process. It's a long process. And so I have had experience with different types of investors, institutional. I've spoken to some pension funds, some larger allocators as well. And so, it's all sorts of people.
So
All right.
that's an interesting point, Ken, just one sec. So there are individual investors, but there are other types of investors. So you want to just touch on that briefly?
Yeah, so I mean, institutional investors are like large capital, right? They will, like, some of them will. We have had talks, and they won't invest. They won't even entertain a deal if it's less than $25 million or $50 million check. They will not entertain a deal. Like, I was talking to somebody yesterday, and they have an investor that does private debt, and they were like, they will not give a debt less than $700 million. So it's very interesting to, it's a very different paradigm while you're talking about that, but there's a lot more due diligence. If you're brand new, they will not even look at you. They will not trust you. It takes a long time to build that relationship. Again, constant follow up with them. So I've been in follow ups with them for a long time, constantly staying in touch and presenting the right opportunity to them. And that's how you kind of make the connection.
Yeah, I heard, I think it was from Bridger Pennington, that you have to be on your third fund basically before institutions will even consider looking at you.
Yeah, I think they need to see some track record, right? They need to see that you're a serious person and you're not just wasting their time. You understand the numbers. Because what happens is that with larger allocators, they're very, very heavy on due diligence. They are very heavy on looking purely at the deal, and they want to make sure that their time is valuable, right? So they want to make sure that you're going to be presenting the right deal to them, which fits their buy box. Now, that being said, I would recommend that if you want to play in that sandbox, start building those relationships early, because guess what? You can always the relationship you can build, and that's where the capital is erased, is like in the relationship. If you start building the relationships early without the pressure of a deal, now you've had that longevity of that relationship, and when you have the right deal ready, you can go and talk to them.
So how, like in terms of non-individual investors, how do you even make that connection to them? Let's say you have some experience. Are you calling family offices, cold
I know. So
calling?
I've met them in conferences. I've been to conferences. I met them. I stayed in touch with them. I did not have a deal to present to them.
Okay.
I was just constantly in touch with them. Follow up. A few months later, 1 month later, 2 months later, and then you make the connection there. I'm in a lot of different circles. I'm in some private equity circles, venture capital circles, real estate circles. I'm in a lot of circles, constantly networking, constantly meeting new people. And so it's basically, for me, in my mind, it's like a jigsaw puzzle. Like, I have these things, who will it fit for? And then I find them like, okay, yeah, look, I have something that's really cool. Do you think you would be interested in this? And yeah, if it's okay to be not interested. Just ask for their feedback, ask for guidance. Okay, what do you think we should be doing better?
Yeah, no, that's a good tip. Just getting out there and networking is critical. It's like you never know who you're going to meet, and following up is important too. All right, I interrupted Ken. Sorry. Did you have other question? Another question?
Let's see here. You answered a good amount of them that I had written down there. Oh, You said you live in Virginia, but where is your main market that you're looking at? Do
It's
you
the
have
Midwest. It's Columbus, Cincinnati. Those areas are our main markets.
Okay.
Ohio.
Midwest. Yeah. So we're actually setting up a Midwest multifamily fund right now. Again, because of the challenge being that we've seen so many deals, we were ready to get into them. We were actually investment final for one of the deals. And then again, we lost the deal. Again, I don't want to have a situation where we don't have capital ready to go and, the deal slips out of our hands. So we just go in, we just scoop up the deal and, figure it out. And so that's why this whole, point of having a fund ready to deploy capital, and then you're not worrying about how it's going to go, where the capital is going to come from or not come from. That's the reason. But that is going to be my third actual fund. Two have been SPVs or fund of funds, and then the oil and gas is an actual fund that we have. It's a pretty sizable fund. The first one, the second round is also going to be pretty big. My development fund here in Virginia is also pretty sizable, that we're raising 15 million for that. And we already have commitments for all of it. So we don't even know if we can get any more investors into it or not. And then this is going to be my third fund that I'm going to be setting up.
Now, do you have a different buy box for each fund? I mean, let's say real estate versus oil. Obviously, that would be something completely different. But let's say a Midwest fund or a Virginia fund, do you?
Yeah, so it's completely different. It's completely different. So the Virginia fund is a purely development fund. So we're developing small multifamily in the area. I've partnered with a developer. He's been in the business for 15 years. We've partnered together. We've set up this fund, and we're basically developing small multifamily in the area and then renting it out. And we have our, unique niche or niching down into some strategies that we have. There's going to be some single family play also in that fund. And so that's a very different fund from my Midwest multifamily fund, which is going to be, buy and hold cash flowing properties, value add. So it's going to be very different from this.
Okay. So how do you assess the buy box in each area then? Like, your thesis, I guess, if you will, for your fund.
Yeah, I think it really depends on what you want to do, what you're comfortable doing, right? So it really boils down to what you want to do. I don't know if there's a way to say that this is the right way or the wrong way. Like some people, like for example, Grant Cardone, he will never touch the properties that I'm looking at. He only buys A plus properties. I will never buy those properties because, well, I should not say never, but I'm not buying those properties right now because they don't have the same cash flow. They don't have the same, appreciation based on the NOI that I would see with, a BC property that might be value add.
So you're looking for value add properties that you
we're looking for value add property. I want to generate the alpha for the investors, right? And so that's why I'm looking for those properties.
Gotcha. Okay, I'm going to open it up to see if anyone else has any other questions. Stefan?
I got a few questions. So, what's the return on investment?
That's a great question, and I would say it depends on what you're looking at.
Okay.
What asset class? What product are you talking about?
I was in general. Okay, so, and then the I'm going to say this, it's going to sound funny, but I'm serious. All right. If you were to help me make money to invest in your
fund
real estate, I'd invest. So I'm putting the ball in your court. You help me, you got my money for life.
What do you need? What do you mean by that? You got to clarify. What do you mean by help you make money? That's what I'm not understanding.
Well, I would need to contribute money toward your fund towards buying real estate. So you help me make the money, I'll invest, and you can do whatever you want with it.
Well, again, I'm not understanding how would I help you make the money is a question that I don't have an answer.
I think he
to
meant
that
the return on investment. What kind
is that what you're saying, or is like the initial seed capital?
If I would have to put up $2,500, hypothetically, you help me make the $2,500, I'll put it in, and I'll just leave it there for life.
Here's the thing. It would be a whole lot easier for me to find the $2,500 or the $25,000 or the $50,000 than do that. And again, I'm not saying that I'm not happy to help people. I'm really happy to help you, but I got to understand where you're coming from, right? What do you need help with? You're saying help me make money, but there's so many ways to make money.
Well, it's sort of like the down payment, so to speak. Help me make the down payment for your.
I don't have a course. You don't make a down payment. It's an investment. I don't have a course.
No, I
Yeah,
get it.
we can take this offline, I guess. But Stefan, I'm trying to understand. So are you saying don't put any money up at
Yeah.
first?
Like, no money down. How do I go about it with no money down? That's
I see. Okay,
that's
so
real.
now I understand. So you want to buy a property zero down, essentially, is what you're saying, and then basically the profits that you make from that is what you would invest.
Yes.
So maybe like
Okay, so
finding the deal.
got
you
it.
know.
Okay. Yeah, we can talk about that. I can help you, guide you on that. That's not a problem. I can help you. I can connect you with people who do this, who can sell you, properties zero down. Now there is going to be some entry fee to the properties. These are going to be cash flowing properties. I can connect you with people who do that all the time. I have people who have properties that you can get into for, on seller finance, subject to stuff like that you can get into easily.
Are they single family, multifamily, or apartment complexes?
They're either single family or small multifamily. Typically, you will not get into larger apartment complexes like that.
Okay. Fine.
I'll connect you with Stefan.
Okay.
Yeah. I would
offline.
love to understand what your situation is before, I can help you with this. And, I'm happy to help you. If I can connect you with some people who can help you, yeah, I would love to do that.
Okay. Great.
All right,
Don said you would help me, right?
Yeah, I'll connect you. I'll connect the two of us together. All right.
Yeah.
Okay.
Janice has a question. Janice, come off
Thank you,
mute.
Hi.
Hi, Janice.
I'm completely new, so I'm learning a lot, and thank you so much. It's really interesting, really interesting. But I had a couple things that you had said that I just maybe you could elaborate on if you
Sure.
don't mind. You were talking about the touch points.
Yes.
Had like 11 touch points across 7 platforms. Is that what you said? And
Let me pull it up. I don't want to misquote the data. It's called the 7-11-4 rule.
oh,
You can look it up, 7-11-4 rule. So it says that before, what Google says is that Google research revealed that before someone buys, I'm reading off of Google, by the way, buys from you, they need 7 hours of engagement with your brand, 11 touch points of engagement, and 4 separate locations.
okay. Oh, okay. I will look that rule up. Thank you.
Yeah. So that's what I was quoting.
That's awesome. I also you had mentioned when you were talking about that, I was wondering, do you use repeat content? Like, do you make something? Say
Yes.
you make the
You always
website-
repurpose your content. You should always repurpose your content, use it in as many ways as possible, put it across different platforms. And, different platforms work differently. Say, for example, you're putting it in Instagram stories or Facebook stories, they disappear in 24 hours, right? Not everybody would have seen them. You can repeat them. If you put it on LinkedIn, it's like a scrolling thing, so it doesn't stay there. It'll go away. So you can put it again. And so you can see what are your top performers and put them back in. You may repurpose the same thing, put some different text there and put it there.
Yes. Okay. Yeah, you're right. The scrolling, of course. And I also wanted to ask, wait a second. I wrote a couple things down. Oh, what can you say again why the B and C properties instead of the A properties?
Yeah, so typically what happens is that when you're buying an A plus asset, there's not a lot of value add that you can do, right? So if you're familiar with, how multifamily works, typically your properties are valued as businesses. So it depends on the income that it's generating. So the more income that you can generate, now I'm not, again, the caveat being if you're buying stabilized assets, stabilized meaning everything's been done, they're good quality assets, and there's nothing else that needs to be done. You're just buying to hold them, right? There, you're not generating any new extra revenue in the business other than the natural appreciation of the project that's going to occur, or the natural increase in the income from the rents that's going to occur over time, right? So obviously, the valuation of the property that's based on the increase in your revenue that you're generating is not going to be there because you've really not done a whole lot over there. Now, say you had an AA plus asset which had under market rents. Now, if you bring the rents up and they're at market value, yes, now you've generated value. Now you can actually get a higher return on that. So when I say AA plus, I'm typically talking about the fact that, these are like stabilized assets that I don't want to buy. I want to buy opportunities where I can add value. I can say it's an older apartment complex. I can maybe add some amenities there, add some streams of revenue. Maybe I can add some paid parking there. Maybe I can add some washer dryers there, right? These are streams of revenue that were previously not existing in the building. And I've added these. So what's happening is that my business is now making more money. And because it's making more money, the valuation is going to be much higher. What that means is that when I sell that property, it's going to be valued higher than now.
And that's where he'll make his money, the additional revenue income from what he's done.
The sale, yes.
That's amazing. And I'm guessing it's probably better for your taxes as well. I don't know anything
No,
about
the taxes are completely different. And I
okay.
won't go there because I'm not a CPA, so I would not go there.
That's just a guess.
So Janice, if you just think A, B, C, D, and what Avishkar was saying, there's like plus, like A++ is the highest, but like D, think about dumps, like the worst neighborhoods, and C's in like a little better, but B, somewhere like value add is somewhere CB. It just depends on the neighborhood. Sometimes even B to A, you can do value add.
Yeah.
Just depends.
Yeah, absolutely. And you can do a value add and actually an A+ too. Like I said, if it's under market rent, say, for example, there is an amenity that you can add there that didn't exist. For example, there's an empty yard there. Now you add a pickleball court and you're just kind of charging something for that. Like you just added value. You added more income there, right? You add a dog park or something, and then you charge higher rent for that. You just added value. So there are a lot of ways you can add value to a project. It doesn't necessarily mean that only BC properties can have value add. Even A properties can have value add. It's just slightly different.
Yeah.
Okay, but with BC properties, you're also, I'm guessing, taking a chance on like how much you're going to have to fix up, or well, I guess you're not taking a chance if you study.
Well, you create the business plan beforehand, right? And so once you've created the business plan, you execute on the business plan, and if the business plan has been accurately projected, then your returns are going to be expected to be around that or higher.
Yeah, so you do due diligence on every property that you buy, right? So
yeah, typically buying these larger complexes, it doesn't happen in a week. It takes months.
Right.
To do that.
What and my last question, sorry, I hope I'm not taking up too much time.
No, it's good.
When you are doing this and you're putting a team together, what jobs are on the team? Like
there are a lot of jobs. There are a lot of things to be done.
So there might be like 10 people on a team, or
no, you would not have 10 people. You would have probably 3 or 4 people on the team at the most.
Okay.
And
then
there are different people.
All divvying up the jobs.
Yeah, they're divvying up the jobs. Sometimes people just have 2 people if they're full-time into real estate. Like I'm practicing medicine and I'm doing this on the side. So I obviously need a slightly bigger team. Some people will just have a 2-person team, or somebody might just do it solo. If they have the experience, they might say, look, I'm just going to do it by myself. I don't need anybody else. I'm doing this full time. I already have employees under me that are taking care of it. They report to me, and they might just do it solo. I know somebody who does that.
So Janice, Legend's first deal, Alex's first deal in Las Vegas has the largest team. Yeah, because he wanted to give a lot of people opportunity to participate, but generally it's like Avishkar said, kind of small controlled group. And there's different roles like finding a deal, underwriting the deal, putting up money to close the deal, raising capital, asset management, which can be a lot of things, working with the project manager, doing repairs, all different kind of things with asset management. There's somebody called the key principal, which will help with the loan closings, different for funds than it is with non-funds, but
Yeah.
there's newsletters that have to go out. So there's a lot of opportunity dealing with refinances. People can do a lot of different tasks on a GP team. Okay, so we
Thank
just
you.
had
Thank you so much.
any other questions? Janice?
No, not that I mean, no, I don't know enough to ask.
Okay, no problem.
Thank
You
We
know where to
all have to
find
start
us.
somewhere. Just keep that in mind.
Yes, thank you. I appreciate.
I started with not knowing anything, so that's a good
Yep.
place to be.
Yeah. Education is the most important. Kalina, any questions from you? She's still with us, or Joanna? Oh, Kalina.
Yes. Well, actually, it was pretty detailed and interesting how a beginner that is in a totally different business gets their feet wet in real estate. And absolutely correct. You started with the master classes to gain some knowledge and build up upon it to figure out how investment in real estate will make sense for you. I am impressed that you quickly kind of accelerated into setting up different funds. How did the transition from your fundamental knowledge of real estate help you to be able to create several funds?
So yeah, I think it's funds kind of work in a similar way that you're deploying it into some opportunities, right? Fund is basically a store of money that's getting deployed into opportunities. It's really about understanding where those opportunities are, how you're looking at them. And essentially it's about having a good team. Like I said, a great product will be brought down by a pretty horrible team, and an average product can be made into a great product just by having a good team. So it really heavily depends on the team that you're working with. And so finding the right team, finding the right people for those projects is what you need to do when you're working on, especially in the funds and whatever have you, and then understanding, because otherwise the numbers are the numbers. You can understand the numbers fairly quickly. You can have analysts look at this stuff. At the larger scale, you do have some third-party due diligence that can be done. Like for one of our, our oil and gas fund, we do have a third-party report also. They're independent, independent due diligence that these people will do, but they'll not look at funds that are less than, either 25, 50 million or whatever. So it's going to be a larger allocation, bigger fund that they look at. So that's definitely there. And so a lot of other things that go into it.
So actually, where did you learn about funds, and making that transition from?
So again, I learned from some mentors. Then I went through books. I'm actually going through, I don't know if you guys can see this book. I'm going through this book these days.
Read the name, Venture Capital. It's hard to read.
Venture Capital and the Finance of Innovation.
Venture Capital and the Finance of Innovation.
Yeah, I'm a fan of learning, so I'm always learning new stuff. And so, I'm in like I said, I'm in a private equity venture capital community. I've had people who've set up funds before me, who've guided me. I don't know if you guys know Pace Morby in this Up to World. I'm actually in another community with him, and his fund manager, I had a one-on-one with him for like an hour to understand how they're doing their business, what their, stuff looks like. So yeah, it's basically understanding from people who've done it before. Not you don't need to reinvent the wheel. You just go and find people who've done it and then just let them help you.
Oh, that's great. Kalina, did that answer your question? Do you have any others? And we'll get to Joanna's question in a second.
Well, yes, it did answer the question. I have seen some of the webinars. I think Richard Paddington was doing on funds, and they're pretty
Richard.
complicated. There are a lot of strict rules and regulations that apply to funds. So my question was, I understand you're saying you're teaming up with people that understand funds, but my question was, how did you yourself felt comfortable to set up 3 different funds? Do you rely on other people's knowledge, or
Well, I have my attorneys, right? So that's why you get attorneys. That's why you pay them to understand what they're doing. That's why you have a CPA looking at your taxes. That's why you have a CFO looking at your finances. That's why you have, like I said, the fund has its legalities, right? It's not necessarily complex to set up a fund per se. It just has its legalities. You got to make sure you're doing everything within the purview of SEC and FINRA. And so that's where the lawyers come in. You hire a securities attorney for that, and then you get, your fund set up. But even before that, you got to have a fund thesis ready. You got to understand what your fund is going to be all about. You cannot just say that I'm setting up a fund and, we'll figure out what we're going to invest into from the fund. That's not how it works. You got to have a very clear thesis. So for, our funds, we have a very clear thesis. For example, for my development fund in Virginia, we have a very clear understanding of what we're buying, right? We're going to be buying XYZ type of properties. We'll, do this kind of a conversion to them. This is what we're going to rent them out at. These are our financial projections on the renting it out. This is what we expect to make out of that. So it's very clearly defined criteria that we have based on which we said, okay, but we need a pool of money because we're doing this project, these projects, not this project, these projects. And so we need a pool of money ready to go because we need capital ready because these deals go very fast. So having that understanding is what you need. The rest is all the legal stuff. That's what you pay, attorneys for, to make sure that you're legally sound. So yes, you have to hire the right attorney. I am not going to do anything with anybody's capital or with finance unless I have a solid attorney, which I do. So, we use securities attorneys helps because that's what, that's what they're here for.
Yeah, but I think you brought up a great point there that, you knew the type of projects that you wanted, which was development, and you knew that you needed capital up front to do it. So that's why a fund made sense.
Yes.
Exactly.
Basically, you had a business plan, and then you'd say, hey, do you want to invest in my business plan? People see your business plan, which, some people don't even bother doing that. So here you had all that. So it makes it a more viable investment opportunity.
And that's the way any fund is, right? Yeah. That's the way any fund is. You have to have a thesis ready. That's called a thesis, investment thesis. Mm-hmm. What is your fund going to do? Like, you cannot just say, I have a fund. Like, what is the purpose of that fund? Where is it going to invest money? And the other thing is that I would say that you cannot say, well, my fund is going to invest in oil and gas. It's going to invest in multifamily. It's going to invest in development. It's going to invest in RV parks. You cannot do that. No. You cannot say that, I'm going to incorporate everything into this. You have to have a very clear direction of where your fund is investing in. And the first thing that you got to do is think about the thesis. What you're worried about is the legal stuff. Yes, it's important, but that's why you hire attorneys to do it.
Mm-hmm.
Got it. Okay, Kalina, does that answer your question?
Yes, thank you. Appreciate it.
All right, we're gonna move on to Joanna. I know you typed your question in the chat, so let's see. What are the most important things you look at building your dream team?
Oh, that's a good question. I think it has to be, it'll vary from person to person and, what kind of skill set you're looking for. So for example, something that I want is like somebody who's going to be a team player, who's not going to be like, that's it, I'm going to do what I'm going to do. I don't care about what everybody else is doing, right? Secondly, I have to see if I'm going to be hiring like somebody, like for example, in my multifamily team, the person who does the underwriting with us is a CPA. She understands numbers pretty well, right? So you got to hire the right person for it who has the knack for it. I can underwrite. I don't enjoy doing it, but that being said, I do give strategic guidance on, okay, this comes here, let's do it this way. And at this point in time, I don't even do that. I'm like, they know what to do. So so it really depends on what skill set you're setting the team up for, and it's going to be sometimes it's going to be trial and error, because I've had to let people go from the team twice already, and we've got new people come in, but some of the people have stayed on. And so it really is about who you gel with, what their vision is. Do you guys have a shared vision that you can align on? Because you're building something together, and so your team has to align on that shared vision. There cannot be you. The thing is, when somebody forms a team in the beginning, it's very exciting. Everybody's on a high, but then you got to make sure that it sticks through it, right? So, like I said, my team's been with me for 2 years now. It's going to be very hard for me to lose that team, because I don't want to go experimenting with new people unless something really bad happens.
Yeah, it's been important. We had we were so eager to get into real estate early on in our journey that we thought everybody, was trustworthy and that they did what they said they do. And boy, oh boy, did we have a wake up call with that. So take your time, find the right people.
I think that's what happened. We got lucky because we didn't have any deals. That gave us a lot of poise and a lot of time to figure out our internal team and how things were working and not working. And honestly, when we let go of one of the team members that we had to let go of, had we had a deal at that point in time, it would have been a mess for us. It really would have been. It wouldn't have ended well for us. So we got lucky there.
Oh, that is a good timing then, that it worked out for you.
Yeah.
Antonio, any questions from you? Stefan's dinner time is here. Thanks for joining, Stefan. I don't know. Antonio, are you there? All right, maybe not. Okay, so let's wrap it up then. And any last oh wait, Antonio's off mute. Hi, Antonio. Any questions that you have?
Hi, everybody. Sorry, I was doing family stuff, but I was listening very attentively. So, a lot of what the gentleman said is very true. I'm new to this as well. I started with the deal, kind of put a team together. Our underwriting was way too conservative for me. So it was hard to do the deal. It was a very large deal. It was $100 million deal. We were trying to get a part of it, which was just in Bergen County, New Jersey. It was 5 different properties, a total of like 207 apartments over 5 properties. So he's right. What I've learned in the last few months is you always have to be raising capital. So I've transferred my focus to that. I'm not new to everything. I do have a degree in finance. I do follow the economy, and I have a financial background in finance and economics. So, but he is right. You should be always raising capital. That's what I can add. And it's the more knowledge you have is great. If you go to conferences, seminars, but doing a deal or trying to do a deal will give you a ton more knowledge than any book would ever, give you. So
Thank
it
you
takes
for that
time.
great point. Yeah, no, that makes sense. I know you're in Caldwell, right?
Yeah, I'm in Essex County, New Jersey.
So we're in
Um,
Passaic County, so we have to figure out how to get together.
Yeah.
All right. Well,
And
thank you for
the
that.
invite.
Oh, you're welcome. I'm glad you can make it. All right. Well, let's just wrap it up. Your last points, lessons learned. Have you ever lost money with any of this? What do you want to share?
Oh, well, yeah, I mean, I think it's the biggest lesson that I've learned is that you need to be patient with this stuff, and there are going to be a lot of ups and downs, and you just got to ride with it. And if you're getting into raising capital, you got to understand that you're going to be handling other people's money. So, you got to really be sure of what you're doing, but at the same time, you got to understand that it does come with a lot of emotional weight and emotional baggage, because some of these people you will know, and some of your investors will become your friends over time, and you don't want them to lose their money because you got them into an investment. But unfortunately, sometimes that will happen. So you got to make sure that you create that that boundary there, and you make sure that you overemphasize this and tell them every time that, look, this is an investment, you can lose your money, is what I would say.
Yeah, no, unfortunately, I had that experience with my sister on an investment that we both did. I mean, not together. She did one, I did one, and we both lost some money. So yeah, it's very uncomfortable, it's super uncomfortable. So I always think twice about an investment before I recommend it to anyone. Well, thank you so much, Avishkar. This was really terrific.
Thank you so much for having me. I hope people were able to gain something from this, and I hope
Absolutely.
it was valuable to the people listening.
Yeah,
Thank you. Yes,
absolutely.
very much so.
Within a week, it's going to be up on our website. I mean, our YouTube channel, which is youtube.com/@ hookup with real estate. I'm just putting it in the chat with real estate. And, we'll see you next month. Thank you again.
Right.
It's been
Take
wonderful.
care.
Thank
Thank you
you.
so much. Thank you
Really
for having me.
appreciate
Have a good night.
All right.
Thank you.
Bye-bye.
Bye.
Okay, take care.
Bye.
Thank you.